Well, hello, I'm Chris McAlpin, the Chief Experience Officer with Sound Financial, and I hope that you're doing well. And I'm going to answer the question, what causes stock market crashes? And I love this question because I get to totally nerd out on one of my favorite topics. But I also love this question because you're asking me to predict the future. Yep, that's exactly what you're asking me to do. Because if you're wanting to know what causes stock market crashes, I'm assuming you're wanting to know what avoids them. So you are an investor and you want to go diving into the markets and you know that you're supposed to buy low and sell high. You just want to figure out where that high level is and get out, take your profits before the market crashes. I get it. I fully understand it. I've tried it myself, but I got to tell you, I cannot predict the future, and neither can you, and neither can anyone else. So I want you to be aware of people that go, hey, the market's going to crash next week, next month, next year, because they simply don't know. It cannot be done. But we can study history. We can study data. We can study facts, and we can know what caused, past tense, the stock market crashes of the past to get an idea of what can cause or could cause or might cause the stock market crashes of the future. Okay, so here's the short answer to the question. The short answer is that when stock markets get extremely overvalued and there is a catalyst, when those two things come together, then we typically have a stock market crash. So the big four examples are, and there's many more, and there's typically you consider the big three. The big three are this: 1929, 1973, 1974, 2008, and 9. The 2000, 2002 market and the 2020 market follow some of the same catalyst examples that I just gave. So I'm going to discuss all three of these just a little bit. This is a mistake most people make. They look into history and they're looking for that sole cause. Okay, I want you to avoid looking for that sole cause. Stock markets are too complicated. I mean, the economy is made up of hundreds of millions of people, and all of us have this piece of the economy ourselves, and the stock market's a big giant scoreboard of the economy. And so it's just way too complex to say that one event caused its downfall. That would be oversimplifying the matter. But if we look at history and kind of peel it back, we can start to see some of the danger signs. Typically, I like to watch the Buffett Indicator. Now, our investment team watches a whole string and a list of other data measurements, but the Buffett Indicator is one of the easier ones to describe. It is simply the total stock market capitalization as compared to the US GDP. And when that level gets around two standard deviations above its historical trend line, there we see crashes happen. So here we go, 1973, two standard deviations, 1999, two standard deviations, 2020, two standard deviations. It was not measured in 1929. I guarantee if it was, you would have been at two standard deviations then as well. And so 1973, you had massive oil market disruptions or energy market disruptions that became the catalyst for the 73-74 crash and the lost decade of the 1970s. In 1999, well, in 2000, you had a recession. 2001, we had terrorist attacks. Each were catalysts for a massive sell-off in the market and the beginning of the lost decade. Now, in 2008, we did not have two standard deviations of overvalued, but we had a massive debt crisis and real estate crisis that triggered a massive market sell-off that was in the middle of the lost decade. And you had very much hangover lingering effects from 2000, 2002. In 2020, we had something a little different. We had two standard deviations above its historical trend line. The stock market was. It was the most overvalued U.S. stock market in history as compared to the GDP. The global pandemic was without a doubt a massive catalyst. You had, more so in history, the two triggering events that you needed for an absolute stock market debacle. And over 3 weeks, we got a 38% sell-off in the US stock market. I was there. It completely sucked. Now, what happened? Professionals sold immediately, took profits, got out of the way. So why didn't we have just a massive crash? Well, the Federal Reserve leadership, those professionals, those guys are economists. They study history also. They knew exactly what could happen. They turned on the United States printing presses and flooded both the economy and the markets with more money than we've ever seen flood into the economy or the markets. By many estimates, over $5 trillion hit the street in over 5 months. That is why we didn't have a crash. That's why we had a V-shaped recovery, and that is the only reasons we had a V-shaped recovery. And so this would be a good place for us to consider what are those danger signs. How can you protect yourself? Well, the number one way is you must manage risk. In the lead up to all of these markets, you had massive growth in both the economy and in the markets. And individual investors start fearing missing out. They start chasing investments that make no sense. And they start diving into these because their friends have made money or they've read about what's going on in the markets and they see the headlines and they don't want to miss out. And then when the markets sell off, they fear loss. In fact, many studies show that we fear loss twice. We feel the pain of loss 2 times more than the enjoyment of gain. And so when the panic selling sets in, investors start to sell off and they sell off near the bottom and they buy all of their losses. Don't do either one of those things. Have a good financial plan that leads to a good investment plan, all that supports the financial goals that you have in your life so that you can go live life. Don't keep score with money or you're going to get sucked into one of these massive bubbles that turn into a stock market crash. And so this is what I want you to remember. What causes the crashes are overvalued levels in the stock market. And so you can go look up the Buffett Indicator, or you can watch historical trend lines and just see how is the stock market's valuation compared to those historical trends. Because math is just math. It's going to return down to that trend line or it's going to grow up above that or to that trend line. That's just how it works. And it leads you to recognize why the number one rule of investing is manage your risk to avoid large losses. I hope this helps you. Take care. Talk to you soon.